Okay, hi everyone. This is going to be the second lecture for chapter 21 here. Believe we finished at slide 13, so we're going to pick up here at slide 14. And we're talking today in this lecture a little bit about liquidating distributions. Now let me kind of caveat this by saying that this part of the lecture is complex. There's various rules, and I'm going to try to simplify it as best I can and let you know what you need for the exam to know. So a liquidating distribution, this would be, as we've discussed in the past with corporations, where basically the entity, in this case the partnership, would distribute something to the partner, the owner of the business, whereby at the end of that distribution, it terminates the ownership interest. So in this case, a liquidating distribution, more specifically, would terminate a partner's interest in a partnership. And as I have here, this can be written into a partnership agreement, or it could be at the end of the partnership life cycle in a complete liquidation, right? Now, two things we care about from a tax perspective in this are, from a partner's perspective, what's the gain or loss on the distribution, right? And then second is, how do we allocate us, the terminating partner, our outside basis to these distributed assets? Because we've seen when things are pushed out from the business, we kind of have to eat away at our basis. So how do we handle these two things? Now, in an ideal world, there's going to be no gain or loss on the distribution because the asset, the bases of them, will be the same in the partner's hands as they were in the partnership hands. However, this isn't really the way it works in practice. So let's look at issue 1 and then issue 2. First issue is a little bit simpler than the second one. So the first issue here is going to be, what is the gain or loss that the partner needs to recognize upon a distribution, a liquidating distribution? And the general rule here is going to be the partnership and the partner do not recognize any gain or loss from a liquidating distribution. However, the exception to this is whenever the terminating partner receives money in distribution of their outside basis, then it's a capital gain. So that makes sense. You just receive more money than your basis. Any excess is going to be a capital gain in that case. So as I have here, right, in distinction to operating distributions, a partner may recognize a loss from a liquidating distribution. However, that's only when there's certain conditions. Specifically, the distribution should include only cash, unrealized receivables, or inventory, and the partner's outside basis is greater than the sum of the inside bases of those assets that are distributed. So as I have here, commonly the terminating partner share of partnership debt decreases after a liquidating distribution. As we've seen before, right, any reduction in a liability, so remember how we said your basis kind of builds in some of the liabilities you're responsible for. When you receive a reduction in that liability, it's in turn going to reduce your outside basis. So let's look here at 2115. So we have a partnership liquidates partner two's interest by distributing 206 in cash, and then inventory with a fair market value of 103 and an inside basis of 43,000. Partner two's share of the liabilities on the date of liquidation is 66 grand. Their outside basis on the date of liquidation is 334, which includes that 66 grand. What is their gain or loss? Okay, so the first thing we got to do here is we say we have 334 as our outside basis. We are off the hook now for 66 grand, right? We're no longer responsible for it. That's going to reduce our outside basis to 268. Then what we do is we say, okay, we now have 268. This is a liquidating distribution. In this case, we're receiving only cash, inventory, and or unrealized receivables. So in this case, it's cash and inventory only. Our outside basis is going to be greater than our inside basis. The 268 is greater than the 249. So that excess we're going to be able to recognize as a capital loss. So that's kind of showing the 2 points here. The first one is we did a reduction in liabilities, reduces outside basis. And then you can recognize a loss if the distribution in this case was just cash and inventory, and our outside basis was greater than the sum of the inside basis of the assets that were distributed. The next idea here is, okay, what is our basis in this distributed property, right? We've received, property that's a liquidating distribution. Now, what is our basis in it? And the idea here is that the partnership's going to act as a conduit for the partner's business activities. Overall, then, the general idea here is the rules are going to try to, the best they can, keep the basis of the asset the same, regardless of whether the partnership or the partner holds them. So there should, in theory, be few tax consequences from this. Overall, the objective of the liquidating distribution, what we're going to try to achieve, is to allocate the partner's entire outside basis to the assets that are received in the liquidating distribution. However, this allocation, right, this like the purple item here, what we're trying to do, kind of gets a little bit wonky depending on what is distributed, as well as the amount of our outside basis in relation to the assets that are distributed. So as I have here, the allocation depends on first, the partnership's bases, so the inside bases, relative to the partner's outside bases. And if the partner's outside basis is greater than those inside bases, or if the outside basis is less than those bases. And then second, the type of property that's distributed. These kind of variables right here give rise to 5 scenarios, right? So it's scenario 1, 2, 3, 4, 5. And they kind of break it out in 2 situations where your outside basis is greater than the inside basis of what is distributed. 2 scenarios there. And then your outside basis is less than the inside basis of what's distributed. 3 scenarios here. Now, the idea with these, some of them are kind of like easy to talk about. Some of them are more complicated. There's more kind of calculations related to it. Let's go through them and I'll kind of break this out and let you know like what's reasonable to know for the exam, because some of the math on this can become rather complex. And I don't want to totally bug you down on this. It's important that you know more of the blocking and the tackling. I'm more concerned with the basics than the deep dive. But this right here is just showing those 5 scenarios. Let's look through them. We're going to start with scenario 1 and 2. So we're going to start with scenario 1 here. And in this case, the partner's outside basis is greater than the inside basis of the distributed assets. And what is being distributed here is money and hot assets. We talked about hot assets before. Now I have, if a partner's outside basis is greater than the inside basis in the distribution of, basically hot assets, then the partner is going to recognize a capital loss. The partner assigns basis to the distributed assets, because remember we said the second question here is like, what is our basis in these assets? Equal to the partnership's inside basis. Afterward, once you do that, you assign the basis to the inside basis. Any remaining outside basis is going to be the loss. So let's give this some numbers here to kind of show this. 2116. Okay, so this is scenario 1. And it's a liquidating distribution where we have an outside basis greater than the inside basis, and there's only hot assets distributed. So we have a partner has an outside basis of 334, including their share of liabilities of 66. The partnership makes a liquidating distribution to the partner of 159 grand cash and inventory that has both a fair market value and adjusted basis, inside basis there, of 49 grand. What gain or loss will the partner recognize in this case, and how are we going to assign bases? So similar to before, and this is going to be consistent, we see in a lot of these examples, the first thing we have to do is reduce our outside basis for that debt relief, right? We're off the hook. Reduction in a liability, our debt, as a partner reduces our outside basis. So at that point in time, according to the rules, right, what we do here is we assign our outside basis equal to the inside basis of those hot assets. So here, the inside basis of those hot assets are going to be 208,000, the 159 plus the 49. Anything left over, like any basis left over after that, is going to be our loss, our capital loss that we recognize in this case. So you can think again here, what we did is we reduced it by the debt, then reduced it by the inside basis of the hot assets. The remaining leftover is going to be a capital loss. And if you think about it in kind of a broad hierarchy way, you know, it would be like if you had Apple stock for 200 and they paid you 150 out in cash as a liquidating distribution. Anything left over, that 50 left over, that's going to be a capital loss. It's like I had this thing worth 200, I only got 150, I lost 50. Here we're kind of saying a similar thing. We had 268, we only got 208, we lost 60. The reason, you know, we do it this way and why it's different than that is we have to figure out how we assign the basis. We have different variables here. Instead of getting just cash, we got inventory as well. Let's look at scenario 2 in this case. So we're going to have the same setup. Our outside basis is greater than the inside basis of what's distributed. However, I have here other property is included in the distribution. So when they say other property, they basically mean anything that isn't cash or a hot asset. So, you know, for example, land, investment, machinery, if they push that out to you, it's not cash, it's not a hot asset, it's other property. So what we have to do here is allocate our outside basis to the distributed assets. And when they distribute this other property, so other property being that in addition to money or hot assets, so land and investment, we have to adjust the basis of the other property without converting ordinary gain or loss to capital. So in this case, there's not going to be any gain or loss from the distribution. We basically just tack it all on to the basis of the other property. So let's look at 2117 here. So it looks like we have a liquidating distribution of $50,000 land and land. Okay, so first off, we know that this is scenario 2. We know it's a liquidating distribution. Our outside basis is greater than the inside basis. We have cash and there's land. Land is not a hot asset. It's not money, so it's other property. That's going to throw us into scenario 2. We have an outside basis here of 268. What is our gain or loss on the distribution? So, okay, we have an outside basis of 268. First thing we're going to do, and this kind of touches on the slides over here, step 1 is we're going to determine our outside basis net of debt relief. So that's kind of the 268 right there. We didn't have any debt relief in this scenario, or if we go back to 2168, we did, but we've already built it in, right? 334 minus 66 gets us the 268, so that's kind of step 1 there. And then what it says is, then you allocate the money to, or you allocate basis to money hot assets, and you assign a basis to other property equal to inside basis. As I have here, step 2, the partner is going to allocate any remaining outside basis to the other property that has unrealized appreciation, but only to the extent of that appreciation. And then step 3 here, the partner is going to allocate any remaining basis to all other property in proportion to relative fair market value. Okay, so I know that's a mouthful. Let's go back and look at 2117 and 2118 because it's kind of a simple example and then a more complex example. So here we have 268 net of debt relief. We reduce it by the cash that's distributed. And in this case, because the 218, the remaining outside basis, that's what we're going to basically do here. We're going to adjust the basis of the other property, the land, to equal our outside basis. And there's going to be no gain or loss. So what's kind of the end of the rainbow story from this with these facts? No gain or loss for the partner. The partner receives money and property with a total basis of 70, an inside basis. Therefore, our outside basis, 268, is going to be greater than our inside basis of 70. Therefore, we're going to reduce the outside basis first for the money received, and we assign any remaining basis, the 218 in this case, to the other property. Basically, what we're doing here is we're adjusting the outside basis by increasing the inside basis in the land from 20 to 218. Now, 2 here is a little bit more complex, and this kind of shows us how to do it with the fair market value. So let's look at this here. So suppose a partnership makes the following distributions. All of these items. There's an inside basis of that, and it has a fair market value at that. At the time of the distribution, the partner's outside basis is 334, which includes the 66 share of liabilities. What's the gain or loss on the distribution, and what is the partner's bases in it? So, okay, the first thing we do here is the partner is going to recognize no gain or loss on the distribution and has bases in the assets as follows. So it's going to be, that carryover basis of 268 there. Cash 181, 12, investment A is 2120, 22,880, inventory 43,000. In that case, let's see how we got those numbers over here, this 268 in the calculation, right? So this is kind of the answer, but how did we get to that, right? So first thing is we have to reduce our outside basis by the debt relief. 334 minus the 66 gets us the 268. It's kind of a universal thing we've seen in all of the examples here. Next, once we do that, according to the rules, we have to reduce the basis by money, hot, and then other property. So we have money, inventory, which is the hot property, and then the other property. So 268 minus 181 minus 43 minus 5 minus 10 gives us 29,000 as our remaining outside basis. Now, if we look at some of these items here, right, we can see there's some appreciation right here. It's in there at 5 and it's worth 12. In there at 10, worth 13. There's some appreciation on the items there. So we say here, any remaining outside basis is going to go to other property that has unrealized appreciation, but only to the extent of that depreciation or appreciation. So let's see here in it. So we know there's 7 on here, appreciation, 3 on there. So we had 29, we back out the 7, we back out the 3, right? You can see this carries down 7 and 3, which leaves us with 19,000. And then what we do from here is any remaining outside basis to other property is distributed relative to fair market value, right? So we basically have $19,000 right here that we have to break out between investment A and B based on their fair market value. The 12 over the and the 13 all over 25, the combination of them. So basically of this 19, we're going to associate 9120 to investment A and 9880 to investment B. So with all of this, right, how we kind of do this here is we start, right, with our, let's just look at investment A, right, our outside basis in the investments. It's still the same overall concept as this guy right here. This is like the simple example, right? No gain or loss, and then we just tack on the basis. Whatever our remaining basis is now going to be our basis in those assets we received. But because there's more factors here into play, it's not just land, we have all these investments, we have to follow special rules. So if we look here, we started with 5 as our number right here. That was our starting point, 5. We then, in that case, assigned it up here. 5,000 was assigned from investment A. Then when we looked at the appreciation part of it, $7,000 was going there. And then when we allocated it by fair market value, 9120 goes there. So that's going to be the ending basis in investment A. Similar setup in investment B. So overall, right, what's going on here at the end of the day, because we're in scenario 2, no gain or loss on the distribution. And our bases are going to be 181 in the cash, 20 these in investment A and B, which we get from down here, and then 43,000 in the inventory right here. And again, how we got these right here, investment A and investment B, is because they're other property. And when there's other property involved, you have to follow the multiple steps here to work it out in that formula. So let's then look here at 3 as the next scenario. Okay, for the next one here, scenario 3, this one's pretty straightforward. It's about as simple as it gets, and we've already looked at an example. When our outside basis is less than our inside basis of the distributed assets, and it's just money, basically this is where you're going to have that capital gain situation. So if we look here at 2111, I'm sorry, it should be 2119, not a big deal. Oh, it should be 2111. I'm sorry, the book was right. This is just showing us, in this case, if there is a distribution of cash, right, and it's in excess of our outside basis, the resulting amount is going to be a capital gain. So this is as straightforward as it gets. You're getting more pushed out to you than the basis of your asset. Any excess is going to be a capital gain. So 3 is straightforward and simple here. 4 and 5 get a little bit more complex. They have a similar setup here. So again, we're dealing in this case with the outside basis is less than the inside basis of what's being distributed. In 4, we're looking at just money and hot assets. So I have here, if the partnership distributes money and hot assets, the partner is going to reduce the basis in the distributed assets other than money, but does not recognize gain or loss. Okay, so it's kind of similar as before, no gain or loss. And there's going to be some steps here. The first one is we determine our outside basis net of debt relief. Okay, we've looked at that before, where we're relieved of the debt. Then if the partnership distributed only money and hot assets, the partner is going to reduce the basis of the hot assets distributed, and the required decrease in the basis of the distributed assets is the partner's remaining outside basis less the partner's inside basis in the assets. Step 2 here, and again, I'm going to read all of this, then we'll see how this shakes out. If you're like hearing this and you're saying, wow, that's a lot, I understand. Step 2 is going to say, the partner first assigns the outside basis to the assets with unrealized depreciation. So this is different than before with the appreciation. And then second, afterwards, it's going to allocate any remaining required decrease to the distributed assets in proportion to their adjusted basis using the below equation. So with this one, 4, you're going to want to really figure out your required decrease, how much your adjusted, your basis in this case should go down. You allocate it to the items with depreciation, and then you allocate any remaining outside basis proportionately based off of the inside basis amounts. And I know that's a mouthful. Let's look here at 2119. Okay, so we're in scenario 4 here. Our outside basis is going to be less than the inside basis, and it's money and hot assets. Suppose a partnership makes the following distribution. These guys right here, right? And first thing we can see here is this guy right here has some depreciation on it. It's gone down in value, whereas like this guy has gone up, so it's appreciated. When we're dealing with scenario 4, we care about unrealized depreciation. So it says here the partner's basis before the liquidation is 334, of which there's 66 in liabilities. What's the recognized gain or loss, and what's the basis in the assets after distribution? This is really like the million-dollar question, right? Like, why are we learning about this? Well, we know scenario 4, there's going to be no gain or loss, right? And then we have to kind of modify our basis in it following these rules right here. So first thing we're going to do is step 1, figure out our debt relief. Right here, net of debt relief, 1A. So we were at 334, off the hook for 66. Now we're at 268. Then we're going to want to figure out what our required decrease is here, right? And basically, here's our remaining allocable outside basis. And then if we look at the inside basis right here of these guys, it's all of those. So our required decrease in this case is going to be the 63,000, which is the sum of these guys, that minus that. So that's where we kind of have to go and take things down to 63,000 in this case. Then it says we're first going to allocate this required decrease, which we figured out, distributed assets with unrealized depreciation. Okay, so that's going to this right here. We first assigned it. So it's kind of like figure out required decrease, then assign it to unrealized depreciation. So in this case, we have 19,000 of unrealized depreciation on B right here, right? We said it went down by 19. So if we were at 63 and that we have left our required decrease, we back out the 19. We still have 44 left of our remaining decrease. Then what we do here is we have to, if we say of this amount, we have to allocate any required remaining decrease, the 44, using the equation right here. Allocate any remaining required decrease, basically in proportion to inside basis. So in this case, right, we said that 44 is our required decrease, our remaining required decrease. And we have to be careful here when we look at this because the inside basis is 50 for inventory A, right? So we're going to use 50 there. However, while we started with 25 on B, we just previously right here took away 19 from it. So the interim basis is going to be 6 here. So that's why it's 50 from up here, and then 6 from right here. It's the 25 minus the depreciation in that case. You're going to proportionally prorate it, multiply it times the remaining required decrease. You can see that sums up to 44,000, the remaining required decrease. So accordingly, Our basis and the inventory is going to be 10,714 and 1286 in inventory B. So in other words, it's the 50 plus the 39 right here for A, or I'm sorry, minus the 39, and then 6, which was kind of our placeholder basis, minus the 4714 right here. So overall, like, what's the overall scheme here, right? No gain or loss in this case. And our bases in this case are going to be 10,714 in inventory A, 1286 in inventory B with it. So I know that's like a mouthful and it's confusing. It's not going to be as complex as that on the exam. We'll look here at scenario 5 quickly here, and then we'll kind of summarize. So in scenario 5 here, the partnership's going to be distributing other property in addition to or instead of money or hot assets. So basically it's money, hot assets, or other property, right? We said it's like land, machinery, equipment. In this case, again, no gain or loss. We're going to decrease the basis. It's a similar process to scenario 4, what we just looked at. But it's more complex because the required decrease is focused on the other property than the hot assets. The steps for this are on this slide right here, and you can look at them in the example. If we were to do just like a quick 5-minute overview again of what we've been talking about here, right? We're saying we're looking at a liquidating distribution. Generally, there's going to be no gain or loss on distribution, like at the partner level. However, when it's just money, that's scenario 3, right? Then there can be a capital gain. There are possibilities, right, where you can recognize a loss from the distribution. This is kind of similar to scenario 1, right, of 1, 2, 3, 4, 5. And then we looked at the other scenarios here that don't have a gain or loss, and then there's the special rules for them. So it's kind of like scenario 1 right here, distribution of money and hot assets. We're going to assign it. Whatever's left over is going to be a capital loss. Scenario 2 here, there's going to be no gain or loss to the partner. We're going to assign it, adjust the basis for the other property that we received. Scenario 3 here, this is the easiest. This is just going to basically be, we have a capital gain for the excess we've received in cash. Scenario 4 and 5 are a little bit more complex because in those we have to figure out a required decrease. Look at things like allocation for depreciation, and then allocation of remaining bases proportionately. And what I would say for the exam is don't get like too bogged down on these scenarios 4 and 5. I'm not as concerned with those. I think what's much more reasonable is like scenarios 1, 2, and 3. Just because the math on 4 and 5, it's there for a reason, but it's not the blocking and tackling. It's more of a really deep dive. So you'll see these different kind of variations in the homework questions. But again, I'd say for the exam, try to focus on just the high level stuff. I think 1, 2, and 3 are more fair than 4 and 5. But we'll catch up on this in the next lecture.